Views expressed by Camaplan podcast guests may not reflect those of Camaplan. Camaplan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. Camaplan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Hi, I'm Michael Duncan, and welcome back to The Road to Financial Freedom. This podcast is brought to you by Camaplan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Our goal is to help the listeners learn how they can achieve their own financial freedom through the experience and stories of experts that have done just that. Today's guest is the founder and president of Royal Palm Funding, a private lender focused on short-term bridge loans in the sub-$5 million space. Royal Palm Funding has a nationwide footprint with a focus on commercial real estate and single-family investment properties. For more than a decade, he has been involved in all aspects of the commercial real estate investment lifecycle, specializing in multifamily, office, retail, and triple-N asset classes. I'm very excited to welcome Noah Miller to the show. Noah, how are you doing today?
I'm great, Michael. Thanks so much for having me. I appreciate it. I'm excited to be here and have a great conversation.
I was already excited about having you on, but then you came in and you led with the fact that you're a Philadelphia sports fan.
That's right.
So now I'm just thinking of bringing you on as a co-host at this point.
I was going to say this conversation may turn from self-directed IRAs into Philadelphia sports very quickly. It might be 30 minutes of debating, how the teams are going to do this year. We'll see.
Personally, I'd love that. If we need to, we can just post it as a different episode. I would listen back to it for sure, and I'm sure that some people local to Camaplan would as well.
I think so. Let's start with the self-directed stuff. It goes well. We'll have a second podcast, and we'll talk about Philly sports and be a Monday morning quarterback.
That sounds perfect to me. That is my favorite pastime. So, I'd really just love to start with, even before we get to what you're doing now, I'd love to know a little bit about where you started, how you got into this business, because I found that this journey is hardly ever the same for anyone.
Yeah, I would say so. I think my journey probably started like a lot of people, which is I graduated from college. I was pretty sure I wanted to be in the real estate finance industry. I didn't know exactly what I wanted to do. I took the best job I could at the time to get me into the industry, and that has taken me farther than I thought I would ever get, candidly, which I think was the right path for me. So I started off I took a job as an analyst at a brokerage firm, a well-known brokerage firm in Miami. I was there for about 6-8 months, and I happened to meet some individuals at a large private real estate investment firm who I became friendly with. I ended up moving over there. I started out as an analyst, got promoted to senior analyst, and then eventually became vice president of the acquisition and finance department for their organization, where I acquired about 15,000 units of apartments, roughly $600 million worth of apartments, and then lent on another roughly $200 to $300 million worth of apartments. I spent a long time there. I really loved it. They were a great organization. In 2020, I decided I wanted to go off and do some of my own stuff, especially in the small balance private lending field. So that's what I did, and that's what I've been doing ever since.
Wow. So it sounds like you progressed pretty quickly through the industry. I mean, becoming the vice president of that company. I mean, I guess to me it seemed quick, but in reality, I don't know how many years it was. But it sounds like this is always something that you've seen yourself doing. Is it what you expected it to be?
It's a good question. I didn't know what I expected. I grew up, my family's been in the real estate business, so I grew up hearing my family speak about it. So I had some idea of the language and especially the cycles. When you grow up in a real estate family, you learn very quickly about real estate cycles, the ups and downs, the good and the bad. I think at times it's been exactly what I thought, and at times it's been very different than what I thought. It's interesting. We're obviously in a period now where since 2000, let's say starting from 2010 to 2020, there was such growth in the real estate space. So much money was made so quickly. And now, for the first time since the Great Recession, we're seeing somewhat of a change in the market, which is very interesting. We're having to deal with the market conditions and what comes with that. But again, that's part of being in the real estate business. And the truth is, I see that there's more opportunities now because there's some shakeup in the market than there was 3 or 4 years ago, where everything was good and dandy and everyone was making money. This is really where I can separate myself from a lot of other organizations through opportunistic viewpoint in the marketplace.
Yeah, I mean, something that I believe in is the fact that opportunity comes from holes in the market. It comes from thinking in ways that others aren't. And I think you make a good point that from 2010 to 2020, when everything was kind of dandy, everything was going normal. So I mean, quote unquote normal. What is normal? But now, obviously, it's not happy go lucky all the time because of COVID and everything else that's happening. But I think you're right in that it presents different opportunities to approach the market in a specific way that maybe we haven't seen before or seen in a long time. And I think that ability to approach it in a certain way is probably the most important when it comes to taking advantage of this, kind of wacky period of time as it has been since COVID.
Yeah, you're right, Michael. You're 100% right. And that's what we're doing now. We are adjusting and being competitive in places that make sense in this marketplace. And my business is an interesting business because I'm very much focused on the debt side of the business. At our core, I'm a real estate lender. Mm-hmm. People go out, they buy real estate, they own real estate, they have to come to a lender to finance their projects, and I'm one of those private lenders. What I do is I bring on investors to invest in those loans with me, whether it's through self-directed IRAs or entities or individuals, et cetera. But the interesting thing is I can see the markets moving, because 5 years ago, most investors who said, I want to invest in real estate, were saying, I'm going to invest and buy real estate, or I'm going to invest with an organization that buys real estate, because they were promising high returns, because the markets were moving so quickly, rents were growing so quickly, values were skyrocketing. But the last couple of years, that has completely stopped. Values have been declining, rents have been dropping. So a lot of those investors who want to get in real estate, they're saying, it's pretty risky for me to be buying real estate right now. Where can I invest in real estate, have lower risk, but very similar returns? And they're realizing that the debt space offers that, because we're offering similar returns to the equity returns they were getting, but we're a lender and we're at, let's say, a 65% value of someone else's purchase price. So we're in a safer position in the capital stack, getting similar returns. So you're seeing a shift from people who are buying real estate and saying, that doesn't make sense right now. Let's be the lenders on this real estate instead. So we're seeing these shifts in the market, and again, that's where we're being aggressive. And as the market moves, we'll move with the market. I think you have to, especially when you want to be ahead of the market. But for the time being, I truly believe that the best place to be in the real estate market is in the debt space. You'll get the highest returns with the least amount of risk.
So to continue talking about, I guess, what you're doing now with Royal Palm Funding, when did you notice this specific approach, and when did you guys, or you in particular, tailor your approach to this?
Yeah, well, so I noticed it started to notice it in 2017, 2018. Again, at that point, I was with my former company, which we were doing large, I'll call it institutional size deals. The checks we were writing were on average 20, 40, 50, $60 million. And I was noticing there was a big part of the market that was overlooked, which was these small private investors, whether you call them mom and pop investors or Main Street investors, individuals who were buying real estate between a couple $100,000 to a couple million. And it was really hard for them to access capital. If you're looking to raise 20 million or 40 million, it's almost easier than if you're looking to raise $1 million, because there's a lot of groups in New York, these institutional groups, who will happily fund large real estate transactions and projects, but there's not as many who will lend or fund smaller real estate transactions. That's mostly, you either have to have family members who have a lot of money or friends who have a lot of money who are willing to invest it with you or lend it to you. Even a lot of the banks don't want to touch it. So I realized that there was this missing piece there. So that's when in 2020 I started to play in that, and it's really taken off since then and grown into something very special. And we've helped a lot of people who've come to us and said, The institutional lenders wouldn't look at my deals. The banks wouldn't look at my deals. I couldn't raise the money from friends and family. It was just, I didn't have those connections. So like I said, 2017, 2018 is when we started to see it. And now that the economy's changed so much and most of the lenders have completely frozen and are on the sidelines, we've really been able to step up and take a good and make a good push in the market and expand our portfolio, both from a dollar amount as well as from a geographical aspect. So that's been nice, and that's what we plan on doing for the foreseeable future.
So why is it, do you think, that these the banks, the large lenders, why wouldn't they, do they just see it as a waste of their time to be dealing with these much smaller amounts?
Yeah, to be candid, a lot of them do. If I could provide a loan to someone for $20 million and I'm making 1% on it, or I can provide a loan to someone for $2 million and earn 1% on it, it's the same amount of work. Right. It's the same loan docs. It's the same due diligence process. So a lot of groups, to that exact point, it comes down to the dollar amount. On a whole dollar basis, it's not worth their time. So they have a cutoff, 5 million, 10 million, 20 million, whatever it is. So that's a big reason why they don't want to work on the smaller deals. And again, that's why I like that space, is because we don't have much competition, which is nice. It's nice to be. It's very hard to compete with some of the large institutional groups in New York. You're never going to be better than them. They'll always have cheaper capital. To be candid, I don't want to compete with them. That's not my space. And my investors don't want to either. My investors, they want to be in a space where there's opportunity, where they can actually have high yields for low return. That's what they're looking for.
So did you find the investors first, or was it the other way around, where you found the market and slowly kind of built out the investors that you're probably pretty consistently talking to and speaking?
It was a mixture. I've been in the industry now for 13 years. So along the way, I picked up a fair amount of investors. That investor profile has grown substantially, though, since the company has grown. A lot of our investors are from referrals. They're friends of friends. They're family members of people who invest with us. And a lot of them do invest through their self-directed IRAs. They see the tax benefits and advantages of it. So that's definitely grown considerably over the last few years as people have understood our business model, the pros that come along with it. Again, as well as especially the ones who already have some sort of self-directed IRA or tax advantageous account that they can invest with us through.
And I'm sure that, like, in a lot of ways, both through self-directed and having access to that retirement money, but also just through the sheer fact that you are raising lower amounts of money, it kind of lowers that entry barrier for a lot of people, I would imagine.
Yeah, it's a good point. It is. All of our investors are accredited investors. That's a hard and fast rule. We'll only take on accredited investors. While we do have a fair amount who like to write larger checks, a couple $1 million at a time, we have a lot of investors who are looking to write smaller checks. To your point, they're looking to write $20,000 checks, $50,000, $100,000 checks, more manageable things. And that's another point, which is a lot of the large institutional groups, unless you're writing as an investor, unless you're willing to write $1 million check, they don't want to look at you. It's not worth their time. So we definitely provide access to, I'd say the more bite-sized checks that investors want to write compared to the larger institutional checks that a lot of investors don't have the capacity to, or they'd rather diversify their investments across many rather than putting all their eggs in one basket.
Bite-sized investing, I like that. And yeah, I mean, I could definitely write $1 million check. I just, it's not going to cash. So I'm going to try that, if that's what they insist. Yeah, they're not going to get much out of it. But granted, I don't really think I'm, as a 27-year-old working a 9-to-5 job, I'm not really sure I'm really the target audience.
I'll tell you, that's not necessarily true. It's funny. If you ask most people who they think would be my typical investor, they would say retired or close to retirement age, looking for fixed income, passive income, low risk, nice returns. And while that's a large contingency of my investors, the amount of appetite amongst people that are in their 20s, 30s has grown substantially. I think that a lot of them are saying treasury yields are not high enough for them. The stock market may be a little too risky, or they've already maxed out their allocations in the stock market. They want to get in real estate. Again, as we were talking about before, they want to be invested in real estate. They're afraid of doing it from an equity side where they're owners because there's too much risk. And they're saying, where can I earn a real estate return, but be a little more protected and have slightly less downside? So a large contingency of our investor base is people in their 20s, 30s, 40s. And again, that's also growing, especially as I think the younger generation is learning about tools like self-directed IRAs on Instagram and TikTok, which they didn't know about before. And I think a lot of them are lining themselves up now for a very fruitful retirement in 30, 40 years from now. So it's nice to see a younger generation getting involved as well.
I mean, I can honestly say that before I took this job with Camaplan, I did not know what a self-directed IRA was.
Yeah.
I've never hidden the fact that I don't exactly come from a financial background on this show. But quickly you did the research. Initially for me, I'm like, oh, this can't be allowed, right? You can just use you're always taught, if you're taught anything in school, it was always, you put money in a retirement account and then you kind of just sit around until you retire.
Sure.
But I think you make a good point. I mean, especially during COVID, you saw the younger generation, to be honest, probably just get bored enough to really start looking into the stock market and investing and all that kind of stuff, because we were left with nothing else to do.
Yeah, you're 100% right. And also there were a couple big names who came out with who got news about it, like Peter Thiel, where it came out that he had, I forget, I'm gonna mess up the number, $1 billion or $5 billion in his self-directed IRA, and he didn't owe any taxes on it. And all these news publications were reporting on it. And I think that kind of blew the lid on, let the secret out of the bag and said, here, guys, this is something that's legal and you can do. And I think once that happened, a lot of people realized the potential, the benefits of having those types of retirement accounts.
Yeah, and it's anyone can do it, and nobody is aware of it. I mean, that's the number one thing I think I've learned since working at Camaplan is just how little people are aware of it.
Yeah.
Obviously, I think the older you are, the more experienced of an investor you are, the more likely you are to know about it. But I mean, especially like you said, people my age, a very small percentage of them are even aware they exist.
Sure.
But speaking of the market, and we did talk a little bit about it more recently post-COVID. What have you been seeing in the market, and where do you kind of see it going in the future, and how are you preparing for it? Sorry, I just asked like 6 questions.
No, those are all fantastic. It's something that I think about every single day. I have to.
I'm very sorry that you have to think about that every single day.
I'm smart enough to know I don't know where the market's going. I could guess. I may be right. I may be wrong. I don't think anyone knows, which is why I look at the market a little differently, which is regardless of what happens in the market, are my investments safe and conservative, whether or not there's an economic downturn or prolonged growth. Again, my business is very simple. At the end of the day, we're lenders. Someone's buying a property for $1 million. We're providing them a loan of $500,000, $650,000, something conservative, on good quality real estate in growth markets that I am confident will withstand a downturn. Now that doesn't mean that that means you may have to go through some years where your yields are lower than you would have expected, but at least we're investing in product that we believe in long term, where we can withstand any storm that comes. The market's obviously changed a lot in the last couple of years. Interest rates have gone up dramatically.
Yeah.
Values have come down dramatically. Fortunately, again, we've invested conservatively, safely, and we're all at very low leverages where even if a value decreases, we're still at a good basis. So, our approach is every day, try to find the best deals we can that will withstand any storm, that we're confident are in growth markets, especially high growth markets, and that we're comfortable we can, most importantly, protect our principal investments on these assets. That's our goal every day. So we'll keep doing that. Fortunately, we don't have a fund. There's a lot of groups out there who have funds and they're mandated to place equity. And I think that's where people get in trouble. If you're saying I have 10 million or 100 million that I have to place in real estate this year, that's dangerous. because I think that's when people do deals just to do deals. We're
Yeah.
not like that. We lend on a deal by deal basis. So every deal we do is a specific asset where we're writing checks for. If I don't find a deal for 6 months that I like, I won't do a deal for 6 months. Fortunately, I found a lot of deals because I'm constantly scouring the market. But my point is, we're only doing deals we really believe in. We're never doing a deal just to do a deal. We're never doing a deal just to place capital. We're doing deals because that is a specific asset that we love, that we believe in, that we believe the risk is low and the returns are high, and it's something that our investors will benefit from.
Now, was that a choice that you made due to experience and maybe seeing the way that those larger funds have kind of worked in the past, maybe something that you were a part of? Or was it something that as you were starting getting into this, private lender funding, you you very quickly decided that, hey, I'm not going to approach it that way because of what I've seen happen to others, maybe?
Yeah, I wanted the flexibility. I saw what was happening with other funds where they were forced to place capital, and I didn't like that model. It wasn't a model that suited me. I wanted the flexibility to say, do we like this specific asset? If yes, great. If no, that's fine. Also, go outside of a specific box in terms of geographical range, dollar size, asset class, and lending on a deal by deal basis and raising capital on a deal by deal basis allows me that flexibility. It's also something, to be candid, that my investor group has applauded. My investors have decided and shared with me that they don't want to be in a fund where there could be assets in there they don't like from a geographical standpoint, from an asset class standpoint. They want to be able to say, Noah, I want to be only in deals in the Southeast, or I only want to be deals in the Midwest, or I only want to be in this asset class. So the way I modeled my business is that exact way, where they can see every specific deal and decide, is this a deal they like? Is this a deal they want in their portfolio? If it is, they'll come in and they'll be part of that deal. If it doesn't fit their platform and their needs, they can pass on that specific deal. So it's kind of a mixture of having the flexibility, but also knowing what my investor appetite is and where their risk tolerance is. So that's why I decided to do it that way.
Yeah, I mean, at the end of the day, and obviously I'm preaching to the choir here, but if you had investors that didn't think the same way as you or view the market the same way as you, then they probably wouldn't be your investors for very long or very consistently.
No, absolutely.
I mean, it makes total sense that they're in the same boat of like, I want to invest on individual deals rather than being a part of a fund where I'm sure there's lots of people out there, clearly because it exists, that, hey, I'd rather just be part of a large fund. I'll take the hits, but I'll also take the things that go a lot better than we might expect them to and that kind of stuff. And,
Yeah, exactly. And to that point, we're a small organization.
Yeah.
We know our investors very well. We are not one of these crowdfunding sources that raises money $1,000 from 1,000 people. That is not us. I know every single one of my investors personally. I've met most of them in person, and they know me too. And that's important. I want to make sure that there's a partnership there and we're all on the same page. I want to make sure that their interest, my interest align, because that's the best partnership you can have. If the truth is, if they're looking for one thing, I'm looking for something else, at some point there's going to be some friction. And I don't want that. I'm looking for long-standing relationships where we have the same viewpoint on the market. We have the same viewpoint on risk level. We have the same viewpoint on what happens if something does go poorly. What do we do at that point? Because at the end of the day, this is real estate and there are ups and downs in this market. So again, I want to make sure that we're aligned. So because of that, I have very close relationships with all my investors and will continue to, and again, are very selective about who we allow to bring on as a partner.
I think that makes a ton of sense. And I'm not just saying that because you're the guest on this podcast, but I am very much the type of personality that likes to know everything that I possibly can about anything that I'm spending any money on. And it sounds like that you're of a very similar vein in that way. So I respect it.
Thank you.
And so speaking of, learning, I guess, I kind of hinted at it a little bit, but has there been an experience that you've had since getting into this realm that maybe it was a mistake, whether it was, you didn't do the proper due diligence or something just didn't add up when you were going through a certain deal that you were able to learn from and make active choices in the future to avoid that type of situation again? Have you had any experiences like that?
I'm sure I have nothing. Fortunately, nothing that has caused any real issues. We do a lot of due diligence when we're doing these when we're lending money. We go through every possible document we can from the property standpoint, whether it's financials, leases, inspection reports, and a borrower standpoint where we're really digging into the borrowers. So we'll never do a deal unless we're 100% sure. There have definitely been deals where we've gone through the due diligence and it hasn't come up as we thought, and we've elected not to move forward.
Yeah.
That happens. And sometimes, it's funny. We'll sign up a deal and we'll say, "This sounds great. Is it too good to be true?" And then we go through the due diligence and we say, "That was too good to be true, and this is why." And now we've realized why. And again, fortunately, that's still in the due diligence process where we haven't actually made the investment. But then again, that's why we have the due diligence process, and that's why we take the time to underwrite these deals and dig in, because it's like anything. Buyer beware. You have to make sure that you're 100% comfortable. Just because a borrower comes to us and tells us that the property is earning $100,000 a year doesn't necessarily mean it's true. So there's definitely been times like that where we've caught stuff in due diligence or stuff has come back on title that's not clean. But again, I think that's just part of the business. And you have to know that a certain amount of deals that you sign up and think you're going to do are not going to end up working out because the economics are different. Or maybe the borrower wasn't upfront about an issue that the property was having or something like that.
Was there anything that you took away from your previous career, I mean, to put it lightly, that you were almost surprised how well or how much it helped you in this new venture?
I think the most important thing is talking to people directly and not relying on email and just I think in this business, even though it's a numbers business because it's real estate, it's also a story business.
Yeah.
Properties have stories, and there are properties that go through ups and downs for a variety of reasons. And I think a lot of people in today's world, especially in the lending side, lending's become such a they've tried to put some sort of AI into it where it's you type in numbers into a model, and if it makes sense, it makes sense. If it doesn't make sense, it doesn't make sense. And although there is a truth to that, there's so much more to this business than that. I could take 100 deals and say, okay, do the numbers make sense? They could, but then you're not looking at things like, well, who's the operator behind it? Are they experienced? Are they not experienced? Are they going to put money into the property to fix it up, or are they going to suck out every dollar and then the property is going to be completely abandoned in a couple of years from now? What's going on with the local economy, right? Are there jobs in that economy? Is that economy growing? A property might make financial sense in a model, but if the economy is losing, if that market's losing 5% of its population every year, well, in 10 years, there might not be people to rent those apartments or restaurants to move into that shopping center. So I think talking to people, and this is something I learned at my old career, was find out the stories. Every property has a story. Every borrower has a story. Really understand the stories. Because at the end of the day, it is based on the real estate, but there's stories behind this real estate that you really have to get to know. And if a story makes sense, that's a good thing. If it doesn't make sense, push a little bit why. Find out. It might not be the right property if it doesn't make sense, and that's not something you can learn just by seeing a financial model that says, you're going to earn an X% return. Anyone can make any financial model look like anything. That's the blessing and the curse of financial models, right? I can make a property look really good or really bad by adjusting one number.
Yeah.
And a lot of people get in trouble that way. And so we of course look at financial models. We also have to look at the story in its entirety and the piece of real estate in its entirety to make sure it's something that we like and are comfortable with.
Well, that's a very interesting way of looking at it, looking for the stories. I really like that. That's a very important lesson, I think, because I can just imagine some of the probably very crazy stories that you found along the way.
I'll give you a perfect example. I don't know if you were following it. I'm sure some of the viewers were. Zillow, which is one of the most well-known, respected real estate websites. They focus on single-family homes.
Yeah.
They were going out and buying a lot of single-family homes between 2015 and 2020, and they were doing it purely on financial models. this property's worth 300,000. Okay, so we'll pay 300,000. This property's worth 500,000. We'll pay 500,000. And it was all calculated with financial models. The problem was they were not taking into account a lot of the other aspects. And they ended up selling most of that portfolio off at a large discount and losing a lot of money because they tried to automate it, and it doesn't work. And that's where, again, some companies have gotten into trouble and will get into trouble.
Automation always works to a certain extent, but
yeah,
you can't automate everything.
Yeah, 100%. And again, that's why we are not one of these shops where we're doing 20 deals a week just trying to get deals in and out. We are very much asset specific. Do we like this specific asset? Are we comfortable with this specific asset? Do we like the story? Do we like the economy? Do we like the borrower? So we're much more laser focused, I think. And again, I like that model. My investors like that model, and that's why they're putting trust in me and my organization, that we stick to that model. I think if we deviated from that model, I don't think it would be the right fit for a lot of our investors. And to be candid, it wouldn't be the right fit for me either.
And I think that fit is important, to say the least. So one final question before we get you out of here. It's a simple one, but also not very simple. I ask it to every person that comes on this podcast. And it's simply, what does financial freedom mean to you?
It's a good question. I think financial freedom to me is the ability to have the lifestyle that you want for you and your family and not having to wake up and worry about it every day. And I think that's different to every single person. I think to some people that means you need $100,000, and some people that means you need $50 million. But I think it's just having the calm and peaceness of, I'm happy where I am in my life. I'm happy with where my family is. And I don't need to worry about money every single day. And I think, fortunately, a lot of my investors come to us because they either feel that way about their life or they're trying to get there. And having a fixed income product with principal protection, being in a first mortgage position, helps them sleep a little more at night, knowing that their capital is being preserved or that they're slowly growing their capital. But I think it's something we all strive for, and it's when you have it, I think it's a beautiful thing.
Absolutely. Very well said. Now, could you please tell the listeners where they can find you, how they can get in contact with you? Feel free to please plug yourself.
Sure. So I would love to speak to anyone listening. Feel free to reach out to me. You can go on my website, royalpalmfunding.com. You can send me an email, noah@royalpalmfunding.com, or you can call me directly, 561-400-7936. I'm available nights, weekends. I'm always available. Happy to speak about what we do, tell you a little bit about our programs, show you some sample deals that we've closed, show you some upcoming deals that we're going to be lending on, and just talk through what we do and if we might be a good fit for you if you are looking for passive income, fixed income, monthly distributions, especially through a self-directed IRA type platform, which Camaplan does very well. And I hope we can have that conversation and find a way to work together.
And Noah's contact information will be down in the description of this episode, as always. Noah, thank you so much for coming on. I felt like I learned a lot today. I had a really great time talking to you. So thank you very, very much on behalf of both me and my listeners.
Michael, thanks so much. I appreciate the time. Be well, and go all Philadelphia sports teams.
Oh, absolutely. Go Birds. Go Phils. I don't want to talk about the Sixers or the Flyers right now, but go them.
We'll leave it for the next one.
Exactly. And as always, thank you for listening to The Road to Financial Freedom. If you enjoyed this show, please support the podcast by remembering to rate, review, and subscribe. You can keep up to date with us on Facebook or Instagram at Road to Financial Freedom Podcast. Thanks again, and I'll see you next time. If you like what you're hearing on The Road to Financial Freedom and want to learn more about self-directed IRAs and 401ks, click the link in the description to download a free toolkit with everything you need to get started.